Every time you add another setup to your arsenal, you are diluting the only edge you could ever have built. You think you are expanding your opportunities, but what you are actually doing is ensuring you will never develop the pattern recognition speed required to make money in compressed timeframes. You are training yourself to hesitate, and hesitation in scalping is not a weakness, it is a death sentence. Most traders believe that knowing more gives them an advantage, but in scalping, knowing more creates the exact cognitive load that destroys execution. You are not losing because you lack information, you are losing because you have too much of it, and your brain cannot process conflicting frameworks fast enough to act when the window is 3 seconds wide. Every setup you collect is another voice in your head creating doubt at the moment you need certainty. Every new pattern you learn is another delay mechanism that separates you from the price action. You have turned yourself into a walking encyclopedia of trading knowledge that cannot execute a single trade with conviction because there are always 5 other ways to interpret what is happening. The irony is brutal, and most traders never see it. They think they are getting better by learning more, but they are actually getting worse by fragmenting their pattern recognition across too many frameworks to master any of them. The belief that more setups equal more opportunities is the foundational lie that keeps retail traders cycling through strategies for years without ever reaching consistency. It sounds logical because it mirrors every other domain in life where diversification and broad knowledge are rewarded. If you know 5 programming languages, you can take more jobs. If you speak 3 languages, you can access more cultures. If you have multiple degrees, you have more career paths. But trading, especially scalping, operates on an inverse principle that violates this intuition completely. In scalping, your edge is not found in the breadth of what you know, but in the microscopic depth of pattern recognition within one specific setup under one specific condition. The market does not reward the trader who can identify 20 different setups. It rewards the trader who has seen one setup so many times that their execution is automatic, emotionless, and faster than the internal dialogue most traders experience before entering a trade. When you collect setups the way most traders do, what you are actually collecting is decision points. Each setup you add is another variable your brain must evaluate in real time. More variables mean more processing time. More processing time means you miss the entry, or you enter late, or you second-guess yourself into a smaller position size, or you override your stop because you were not certain enough to commit fully in the first place. The setup itself might be valid, but your execution is fractured by the presence of too many alternatives running simultaneously in your cognitive background. You are not trading the market anymore. You are trading your own confusion about which framework to apply to the market. This confusion is invisible to you because it happens so fast, but it is there in every moment of hesitation, in every late entry, in every reduced position size, in every time you watch a perfect setup run without you because you were still deciding whether it was perfect or not. The truth that destroys this belief is simple but uncomfortable. You do not need more opportunities. You need better execution on fewer opportunities. The losing trader who took 50 trades this month and the winning trader who took 5 trades this month both had access to the same market. The difference was not opportunity, it was selectivity and execution quality. The losing trader saw 50 setups across 10 different frameworks and executed all of them with surface-level conviction because none of them had been practiced enough to feel automatic. The winning trader saw the same 50 setups but only recognized 5 as meeting their one specific condition, and those 5 were executed with complete conviction because they had done that exact trade 300 times before. Same market, same price action, completely different outcomes. And the difference had nothing to do with opportunity availability. It had everything to do with focus. The losing trader will look at their 50 trades and conclude they need to refine their entries or tighten their stops or find better setups. They will not see that the real problem is that they took 45 trades they should never have taken because those trades existed outside their actual area of competence. They mistake activity for effort and effort for progress, but activity without depth is just noise disguised as work. Paul Rotter was a scalper who traded German government bond futures and became one of the most feared order flow traders in the world. He started with a relatively modest amount of capital and built his edge by doing one thing and nothing else. He traded the front-month Bund contract, and he only cared about order flow imbalances at specific price levels where institutional size was being absorbed or rejected. He was not looking at moving averages. He was not concerned with Elliott wave counts. He was not waiting for MACD divergence. He was not drawing trend lines. He was not looking for candlestick patterns. He watched the bid and ask, he watched how size entered and disappeared, and he acted within milliseconds of recognizing a pattern he had seen 10,000 times before. His execution speed was his edge. His willingness to do the same trade over and over and over again without boredom or the need for variety was his edge. And his ability to sit completely flat when his condition was not present was his edge. He refused to trade breakouts. He refused to trade trends. He refused to trade anything that was not his specific order flow setup in his specific instrument. That refusal is what separated him from everyone else. Most traders cannot accept that level of focus because it feels limiting, but limitation is the entire point. Rotter did not need to understand the macroeconomic picture. He did not need to predict where the market was going. He only needed to recognize a repeating microstructure and exploit it before anyone else could. His trading was boring to watch because it was the same thing every single time. He would sit for long periods doing nothing, then he would enter and exit multiple times within seconds when his condition appeared. Then he would go back to sitting flat. There was no variety, no creativity, no improvisation. It was mechanical execution of one pattern repeated endlessly. And that repetition made him millions, because while other traders were debating which setup to take, he was already in and out of his trade 3 times. What most traders do not understand about Rotter's approach is that his edge was not just the setup itself, it was his refusal to trade anything else. The refusal was the strategy. Every time he chose not to trade a trend, he was reinforcing his pattern recognition for his actual setup. Every time he sat flat during a breakout that other traders were chasing, he was building the mental discipline required to wait for his condition. The opportunity cost of not trading those other setups was not a cost at all. It was the price of maintaining focus. Traders think they are missing out when they see price action they do not trade, but what they do not see is that every time they trade outside their one condition, they are resetting their pattern recognition database back to a lower level. They are teaching their brain to see multiple things instead of one thing with extreme clarity. Rotter's brain was wired to see one thing and only one thing, and because of that, he saw it faster and with more precision than anyone else watching the same market. This is not talent, this is the result of 10,000 repetitions of the same decision. Say no to everything except this one thing. Do this one thing when it appears. Do nothing when it does not appear. Repeat until the pattern is so deeply embedded that execution becomes reflexive. In chess, a grandmaster does not think through every possible move when they see a position. They recognize the position instantly because they have seen it or something nearly identical thousands of times. A beginner sees a board full of pieces and starts calculating individual move sequences, considering different options, weighing pros and cons. A grandmaster sees a pattern and knows immediately what the best move is, not because they are smarter, but because their brain has compressed thousands of hours of pattern exposure into instant recognition. There is no internal debate, no hesitation, no second guessing. The recognition is pre-conscious. This is not memorization of static positions. This is recognition of dynamic structures. The grandmaster is not recalling a specific game they played. They are recognizing a category of position that triggers an automatic response. Studies of chess grandmasters have shown that they do not calculate more moves than intermediate players. They calculate the right moves faster because they eliminate bad moves instantly without conscious thought. Their pattern recognition filters out 90% of possible moves before their conscious mind even begins to evaluate options. This is why they can play speed chess at a level that would be impossible if they were relying on calculation alone. Calculation takes time, recognition is instant. In martial arts, a fighter who has drilled one combination 10,000 times does not think about the sequence when they throw it. They see the opening and their body executes without conscious thought. The fighter who knows 20 combinations but has only drilled each one a few hundred times will hesitate in the moment because their brain is running a selection process instead of an execution process. They see the opening, but instead of throwing the punch, they are deciding which punch to throw, and by the time they decide, the move is over. This is not a failure of discipline, this is a failure of training. They trained themselves to be slow by spreading their repetitions across too many patterns. The concept of unconscious competence is what separates professionals from amateurs in every high-speed decision-making field. Unconscious competence means you can execute correctly without thinking about it, without deliberation, without internal dialogue. In scalping, unconscious competence is not optional, it is the baseline requirement, because the opportunities you are trying to capture exist in windows that close faster than conscious thought. If you have to think, you are already too late. The only way to reach unconscious competence is through repetition of the same task under the same conditions until your brain automates the response. Repetition creates neural pathways that fire faster than deliberate thought. This is why elite scalpers often describe their best trades as ones where they don't remember making a decision. They saw the setup, they executed, and the trade was already running before they consciously registered that they had entered. This is not instinct, this is deeply trained pattern recognition operating at a speed that bypasses conscious processing. Most traders never reach this state because they never commit to one thing long enough for the automation to develop. They are always in the conscious competence phase, where they could execute correctly, but only if they think about it. Conscious competence requires mental bandwidth, and mental bandwidth is finite. In a fast-moving market, your bandwidth runs out, and when it does, you freeze, or you execute poorly, or you make a mistake that you wouldn't make if you had more time to think. The scalper with unconscious competence does not have this problem because they are not using bandwidth. Their execution is automatic. This gives them a massive advantage that is completely invisible to traders who have never experienced it. They can execute under pressure. They can execute when they are tired. They can execute when they are emotional, because the execution pathway is not dependent on their conscious state. It is a trained reflex. There is a second component to the grandmaster feel that most traders overlook. It is not just speed of recognition, it is the ability to detect deviation from the pattern before the deviation is obvious. A grandmaster can look at a position and feel that something is wrong, even if they cannot immediately articulate what is wrong. That feeling is their pattern recognition system detecting a subtle difference from the thousands of similar positions they have seen. In trading, this shows up as the ability to sense when a setup is about to fail before price confirms the failure. You feel it in the order flow. You feel it in the way the candles are forming. You feel it in the lack of follow-through. This is not magic. This is your brain recognizing micro-deviations from the pattern database you have built through repetition. A trader with 50 reps of a setup does not have this ability yet. They can recognize the setup when it forms, but they cannot detect the subtle variations that signal whether this instance of the setup is high quality or low quality. They treat all instances of the setup as equal, which means they take the low-quality ones and get stopped out, and then they conclude the setup doesn't work. But the setup does work, they just lack the depth of pattern recognition required to filter for quality. The trader with 500 reps knows the difference instantly. They can see the same setup form twice in the same session and take one and skip the other because their pattern recognition is detecting variables that their conscious mind cannot name yet. This is the level you are aiming for, and you will never reach it by spreading your reps across multiple setups. A trader who has executed one specific setup 500 times has built a database in their brain that contains 500 examples of how that setup behaves in different conditions. They know what it looks like when it is about to fail before the failure is obvious. They know what it looks like when it is about to run harder than expected. They know how it behaves in the first hour versus the last hour. They know how much heat they can take before the setup is invalidated. They know how the order flow feels when the setup is real versus when it is a trap. They know which days of the week it works best. They know which volatility regimes favor it and which ones kill it. They know how it performs before news versus after news. They know what winning trades feel like versus losing trades in the first 30 seconds. This knowledge is not intellectual, it is experiential, and it is stored in a part of their brain that operates faster than language. A trader who has executed 10 different setups 50 times each has no such database for any of those setups. They have surface-level familiarity. They can recognize the setup when it forms. They can enter the trade, but they do not have the depth of experience required to manage the trade with confidence. They do not know how it feels when it is about to stop out, so they exit early. They do not know how it looks when it is about to extend, so they take profit too soon. They do not know what constitutes a valid versus invalid version of the setup under pressure, so they take trades they should skip and skip trades they should take. They cannot differentiate between noise and signal within the setup, so they are constantly second-guessing themselves. This is not a knowledge problem. This is a repetition problem. Intelligence does not solve this. More education does not solve this. Reading more books does not solve this. Watching more YouTube videos does not solve this. Only reps solve this. The trader with 500 reps of one thing will out-execute the trader with 50 reps of 10 things in every single dimension that matters. Entry speed, conviction, position sizing, stop placement, profit-taking, trade management, emotional neutrality, ability to sit flat when conditions are not right. Every component of execution is better when it is backed by deep repetition. This is not debatable. This is how skill acquisition works in the human brain. Imagine you are watching a 1-minute chart and you know 5 different setups. A bullish engulfing candle forms its support. Simultaneously, there is a liquidity grab below the lows. At the same time, order flow is showing absorption on the bid. Volume is spiking. The previous swing high is nearby. All 5 of these are valid setups you have learned from 5 different sources. Your brain now has to decide which one to trade. Is this primarily a candlestick setup, or is it more of a liquidity setup, or is it an order flow setup, or is it a volume setup, or is it a structural setup? Each framework suggests a slightly different entry, a slightly different stop, a slightly different target. The candlestick trader wants to enter on the close of the engulfing candle. The liquidity trader wants to wait for price to reclaim the swept low. The order flow trader wants to enter as soon as absorption is detected. The volume trader wants confirmation of follow-through. The structure trader wants to see the previous high broken. All of these are valid approaches, but they conflict in real time. While you are running this internal analysis, the price moves. Now you are late. You either chase it and enter poorly, or you skip it and watch it run without you, which creates emotional residue that affects your next decision. If you skip it and it runs, you tell yourself you should have been more aggressive. If you chase it and it stops you out, you tell yourself you should have waited for confirmation. Either way, you are conditioning yourself to doubt your process because your process is 5 different processes competing for dominance. If you had only known one of those 5 setups, there would be no decision to make. You would see the setup, recognize it instantly, and execute. There is no internal debate because there is no alternative framework competing for your attention. The setup is either there or it is not. If it is there, you take it. If it is not, you wait. This simplicity is what allows for speed. Decision paralysis is not caused by a lack of knowledge. It is caused by an excess of competing frameworks that all seem valid in the moment. The more you know, the more you have to choose between, and the slower your execution becomes. Traders mistake this slowness for careful analysis, but in scalping, careful analysis is just another way of saying you hesitated and missed the trade. The problem compounds when you realize that each of those 5 setups requires different trade management. The candlestick setup might have a tight stop below the engulfing candle. The liquidity setup might need more room because you're expecting a retest. The order flow setup might be targeting quick scalps based on tape speed. The volume setup might be holding for a larger move. The structure setup might be playing for a breakout continuation. You cannot manage all of these the same way, which means every time you enter a trade, you are not just deciding which setup it is, you are also deciding how to manage it. This creates a secondary layer of decision-making that happens in real time while the trade is running. Should I take profit at the first sign of weakness or hold for the target? Should I move my stop to break even or give it room? Should I add to the position or scale out? Every one of these decisions is influenced by which framework you think you are trading, and if you are not certain which framework applies, your trade management becomes random. You are making it up as you go, reacting to price movement instead of executing a pre-planned approach, and this is why your results are inconsistent. The trader with one setup and one trade management plan does not have this problem. They know exactly what they are doing before they enter.
They know where their stop is. They know where their target is. They know under what conditions they will exit early. They know under what conditions they will hold longer. There is no ambiguity, no real-time decision-making beyond execution of the plan. This consistency in trade management is what creates consistent results, and it is impossible to achieve when you are juggling multiple frameworks. The emotional component of switching between setups is almost never discussed, but it is devastating to consistency. When you take a loss on setup A, your brain associates that pain with setup A. The next time you see setup A form, you hesitate because the memory of the previous loss is still active. So you skip setup A and instead you take setup B when it forms because setup B feels emotionally neutral. Setup B wins, and now your brain starts to believe that setup B is better than setup A. The next time both appear, you have a bias towards setup B, which means you are more likely to force setup B even when it is marginal, and more likely to skip setup A even when it is perfect. This is not a conscious process. This is how your emotional system hijacks your decision-making. Now imagine this process playing out across 5 or 10 different setups. Every loss creates an emotional tag on that setup. Every win creates a preference. Over time, you are no longer trading based on objective criteria. You are trading based on which setup feels safest emotionally in that moment. You have turned your strategy into an emotional roulette wheel. You are chasing the feeling of safety rather than executing an edge. This is why traders who know multiple setups often find themselves trading their best performing setup less and less over time. They start avoiding it after a string of losses, even though the losses were just variance, and they gravitate towards whatever setup has won most recently, even though recent performance has no predictive value. They are letting their emotional system override their logical system, and they don't even realize it is happening because the process is subconscious.
A trader who only knows one setup cannot play this game. If their setup loses, they have no alternative to run to. They either stick with it or they stop trading. This forces them to confront the math instead of their emotions. If the setup has a real edge, the losses are just variance, and over time the edge plays out. If the setup has no edge, they figure that out quickly because there is no other setup to blame or to distract them. Either way, they reach clarity much faster than the trader who is bouncing between strategies and never accumulating enough data on any single one to know if it works. The multi-setup trader can go months or years without ever figuring out whether any of their setups have an edge because they are always switching between them based on recent results. They take setup A until it stops working, then they switch to setup B. Setup B works for a while, then it stops working, so they switch to setup C. They never realized that setup A started working again while they were trading setup C because they are not tracking results by setup, they are just tracking overall profitability, which is a noisy mess of 5 different strategies with 5 different edge profiles being traded in 5 different market regimes. This is not trading, this is gambling with extra steps. There is another emotional loop that destroys traders who know multiple setups, and it has to do with position sizing. When you take a trade you are completely confident in, you size it appropriately. When you take a trade you are only somewhat confident in, you size it smaller. This makes logical sense, but it creates a catastrophic feedback loop. Your high-conviction trades are high conviction because you have seen them work many times. Your low-conviction trades are low conviction because you have not seen them enough to trust them fully. Over time, your high-conviction setups generate most of your profit because you size them larger, and your low-conviction setups generate very little profit or break even because you size them smaller. This reinforces your belief that the high-conviction setup is better, so you allocate even more size to it in the future. Meanwhile, your low-conviction setups never get the data they need to become high-conviction because you are barely trading them with size. You have created a self-fulfilling prophecy where one setup dominates because you gave it the capital allocation, and the other setups stagnate because you did not. If you had just picked one setup from the beginning and put all your size and all your focus on it, you would have reached profitability much faster. Instead, you spread yourself thin, learned 5 setups shallowly, sized them all inconsistently based on recent emotional feedback, and ended up with unclear results that you cannot interpret because you do not know which setup is actually driving your performance. Edges in trading are not universal, they are conditional. A momentum breakout strategy works in a trending, high volatility environment. It does not work in a choppy, low volatility range. A mean reversion strategy works in a range-bound, stable environment. It does not work when volatility expands and the market is repricing aggressively. Order flow imbalance setups work when there is sufficient volume and liquidity. They do not work in illiquid conditions where a single large order can distort the entire book. Support and resistance setups work when the market is respecting structure. They do not work when the market is in a structural breakdown and old levels are being ignored. These are not edge failures, these are condition mismatches. The problem is that most traders do not define the conditions under which their edge exists. They just trade the setup whenever it appears, regardless of the regime. This is why they experience such wild inconsistency. They have a string of winners when the market happens to be in the right regime for their setup. Then they have a string of losses when the regime shifts, and they have no idea why. They conclude that trading is random or that their setup stopped working, when the reality is that their setup only ever works under specific conditions, and those conditions were not present. A trader with one deeply understood setup knows exactly what conditions their edge requires. They know what the market needs to look like for their setup to have positive expectancy. They know what the average daily range needs to be, what the volatility profile needs to look like, what the volume needs to be, what the order flow characteristics need to be, what the broader market context needs to be. And when those conditions are not present, they do not trade. They do not force trades. They do not try to adapt. They do not convince themselves that this time it might work anyway. They just sit flat and wait. A trader with 10 setups is trading in all conditions because at least one of their setups seems to fit whatever is happening. But what they do not realize is that 9 of those setups are being traded outside their optimal regime, which means they are trading without an edge. They're busy, they're active, they feel like they're working, but they're just chopping themselves up. They're paying commissions and taking on risk in trades that have no positive expectancy, and they're doing it because they cannot tolerate the discomfort of sitting flat. This is the hidden cost of knowing too many setups. You trade more, but most of what you trade has no edge, and the few trades that do have an edge get lost in the noise of all the other trades that do not. The ability to identify regime is itself a skill that requires repetition to develop. If you are focused on one setup, you become intimately familiar with what the market looks like when your setup works versus when it does not. You start to notice patterns in the patterns. You see that your setup works best in the first 2 hours when volume is high. You see that it fails more often on Fridays. You see that it performs better when the market is making higher lows versus when it is making higher highs. You see that it works in volatility compression but fails in volatility expansion. All of this is actionable intelligence that you can use to filter your trades, and you can only acquire this intelligence through deep repetition of one thing. If you are trading 10 setups, you never build this level of regime awareness for any of them because you are spreading your observation across 10 different contexts. You're skimming the surface of everything instead of going deep on one thing, and depth is where the edge lives. The ability to wait is the most undervalued skill in trading, and it is especially undervalued by beginners who equate activity with productivity. Paul Tudor Jones has talked openly about sitting in cash for weeks when the market was not offering his setup. He has described his job as being patient and waiting for the market to make a mistake, not trying to force trades every day. George Soros did not trade every day. He has said that when there is nothing to do nothing. Stan Druckenmiller has said that the way to build wealth in trading is to wait for the pitch you can hit out of the park and then swing hard. He talks about taking only a few high-conviction trades per year and sizing them aggressively. These are not lazy traders. These are traders who understand that edges are rare and edges are conditional. Most of the time, the market is not offering you an edge. Most of the time, the best thing you can do is nothing. But doing nothing feels like failure to a trader who has been conditioned to believe that more trades equal more opportunity. So they trade anyway. They take marginal setups, they force trades that do not meet their criteria, and they lose money slowly and consistently. Meanwhile, the specialist is sitting flat, waiting for the one condition they have mastered, and when that condition appears, they execute with size and confidence because they have done it 500 times before and they know exactly how it behaves. Inactivity is not a lack of discipline. Inactivity is the discipline. The amateur sees waiting as wasted time. The professional sees waiting as the setup for the trade that actually matters. Jesse Livermore spent weeks studying the tape and doing nothing. Then he would take one position and hold it for months. He was not trading every fluctuation. He was waiting for his condition. Ed Sakata has said that the elements of good trading are cutting losses, and cutting losses. And then, when you have the right position, sitting and doing nothing. The sitting is the hard part.
It is much easier to stay busy and feel productive than it is to sit and watch the market knowing you are not going to trade it because your condition is not present. But the sitting is where the edge compounds. Every bad trade you do not take is money saved. Every marginal setup you skip is capital preserved for the setup that actually has an edge. Most traders lose money not because they take bad trades, but because they take mediocre trades that have no edge, and they take those trades because they cannot tolerate inactivity. The trader who can sit flat for days or weeks without feeling anxious or unproductive has a structural advantage over the trader who feels compelled to trade every day. This is not about psychology in the sense of discipline or willpower. This is about having trained yourself to recognize one condition so deeply that you know without doubt when it is present and when it is not. When you know your condition that well, sitting flat is easy because you are not sitting flat out of discipline. You are sitting flat because the thing you trade is not there. There is no internal conflict, no sense of missing out, no anxiety about being unproductive. You are just waiting for your condition, and until it appears, there is nothing to do. In modern retail trading, there is a culture of concept collection that has become a substitute for actual skill development. Traders learn about order blocks, fair value gaps, liquidity sweeps, breaker blocks, mitigation zones, displacement, market structure shifts, premium and discount arrays, and a dozen other concepts, and they believe that knowing these concepts gives them an edge. It does not. Concepts are frameworks for interpreting price action, but they are not edges in themselves. The edge comes from recognizing one of these concepts so many times that you can identify it in real time with enough speed and confidence to act on it before the opportunity closes. A trader who knows 10 ICT concepts but has only traded each one 50 times is not more skilled than a trader who knows one concept and has traded it 500 times. The one concept trader has depth, the 10 concept trader has breadth, and depth wins in execution speed every single time. The one concept trader sees their setup forming and they are already in the trade before the 10 concept trader has finished identifying which concept is in play. This is not about intelligence, this is about reps. The market does not care how many concepts you know, it only cares whether you can execute when the opportunity is in front of you. And execution speed is a direct function of how many times you have done the exact same thing. The culture of concept collection creates an illusion of progress that prevents actual progress. Traders spend months or years accumulating concepts, watching videos, taking notes, building elaborate systems that incorporate multiple ideas, and they feel like they are advancing. They have notebooks full of setups, they have charts marked up with 20 different things, they have a mental library of ideas they can reference, but none of this translates to execution skill because they have never practiced any of it enough to internalize it. They are still operating at the conscious competence level, where they can execute if they think carefully about what they're doing, but they cannot execute fast enough or consistently enough to make money in real time. They are students of trading, not practitioners of trading, and they do not see the difference. The student keeps learning, the practitioner keeps practicing. The student collects knowledge, the practitioner builds skill. The student measures progress by how much they know, the practitioner measures progress by how well they execute. These are completely different orientations, and the student orientation is where most retail traders get stuck. They are always preparing to trade instead of actually trading one thing repeatedly until it becomes automatic.
A trader who only knows one setup cannot play this game. If their setup loses, they have no alternative to run to. They either stick with it or they stop trading. This forces them to confront the math instead of their emotions. If the setup has a real edge, the losses are just variance, and over time the edge plays out. If the setup has no edge, they figure that out quickly because there is no other setup to blame or to distract them. Either way, they reach clarity much faster than the trader who is bouncing between strategies and never accumulating enough data on any single one to know if it works. The multi-setup trader can go months or years without ever figuring out whether any of their setups have an edge because they're always switching between them based on recent emotional feedback. They take setup A until it stops working, then they switch to setup B. Setup B works for a while, then it stops working, so they switch to setup C. They never realize that setup A started working again while they were trading setup C because they're not tracking results by setup, they're just tracking overall profitability, which is a noisy mess of 5 different strategies with 5 different edge profiles being traded in 5 different market regimes. This is not trading, this is gambling with extra steps. There is another emotional loop that destroys traders who know multiple setups, and it has to do with position sizing. When you take a trade you are completely confident in, you size it appropriately. When you take a trade you are only somewhat confident in, you size it smaller. This makes logical sense, but it creates a catastrophic feedback loop. Your high conviction trades are high conviction because you have seen them work many times. Your low conviction trades are low conviction because you have not seen them enough to trust them fully. Over time, your high conviction setups generate most of your profit because you size them larger, and your low conviction setups generate very little profit or break even because you size them smaller. This reinforces your belief that the high conviction setup is better, so you allocate even more size to it in the future. Meanwhile, your low conviction setups never get the data they need to become high conviction because you are barely trading them with size. You have created a self-fulfilling prophecy where one setup dominates because you gave it the capital allocation, and the other setups stagnate because you did not. If you had just picked one setup from the beginning and put all your size and all your focus on it, you would have reached profitability much faster. Instead, you spread yourself thin, learned 5 setups shallowly, sized them all inconsistently based on recent emotional feedback, and ended up with unclear results that you cannot interpret because you do not know which setup is actually driving your performance. Edges in trading are not universal. They are conditional. A momentum breakout strategy works in a trending high volatility environment. It does not work in a choppy low volatility range. A mean reversion strategy works in a range-bound stable environment. It does not work when volatility expands and the market is repricing aggressively. Order flow imbalance setups work when there is sufficient volume and liquidity. They do not work in illiquid conditions where a single large order can distort the entire book. Support and resistance setups work when the market is respecting structure. They do not work when the market is in a structural breakdown and old levels are being ignored. These are not edge failures. These are condition mismatches. The problem is that most traders do not define the conditions under which their edge exists. They just trade the setup whenever it appears, regardless of the regime. This is why they experience such wild inconsistency. They have a string of winners when the market happens to be in the right regime for their setup. Then they have a string of losses when the regime shifts, and they have no idea why. They conclude that trading is random or that their setup stopped working, when the reality is that their setup only ever works under specific conditions, and those conditions were not present. A trader with one deeply understood setup knows exactly what conditions their edge requires. They know what the market needs to look like for their setup to have positive expectancy. They know what the average daily range needs to be, what the volatility profile needs to look like, what the volume needs to be, what the order flow characteristics need to be, what the broader market context needs to be. And when those conditions are not present, they do not trade. They do not force trades. They do not try to adapt. They do not convince themselves that this time it might work anyway. They just sit flat and wait. A trader with 10 setups is trading in all conditions because at least one of their setups seems to fit whatever is happening. But what they do not realize is that 9 of those setups are being traded outside their optimal regime, which means they are trading without an edge. They're busy, they're active, they feel like they're working, but they are just chopping themselves up. They are paying commissions and taking on risk in trades that have no positive expectancy, and they are doing it because they cannot tolerate the discomfort of sitting flat. This is the hidden cost of knowing too many setups. You trade more, but most of what you trade has no edge, and the few trades that do have an edge get lost in the noise of all the other trades that do not. The ability to identify regime itself is a skill that requires repetition to develop. If you are focused on one setup, you become intimately familiar with what the market looks like when your setup works versus when it does not. You start to notice patterns in the patterns. You see that your setup works best in the first 2 hours when volume is high. You see that it fails more often on Fridays. You see that it performs better when the market is making higher lows versus when it is making higher highs. You see that it works in volatility compression but fails in volatility expansion. All of this is actionable intelligence that you can use to filter your trades, and you can only acquire this intelligence through deep repetition of one thing. If you were trading 10 setups, you never build this level of regime awareness for any of them because you are spreading your observation across 10 different contexts. You are skimming the surface of everything instead of going deep on one thing, and depth is where the edge lives.
You now have a choice, and it is a binary one with no middle ground.
You can continue trading the way you have been, collecting setups, learning new concepts, staying busy, telling yourself that more knowledge is the answer, and in 6 months or a year, you will still be in the same place because you will still be spreading your reps too thin to build unconscious competence in anything. You will still be taking trades with hesitation, you will still be second-guessing yourself, you will still be late on entries, you will still be inconsistent in your results, and you will still be wondering why other traders seem to execute with a confidence and speed that you cannot replicate. Or you can pick one thing, one setup, one condition, and you can do it every single day until you have done it so many times that you do not think when you see it. You just act. You will be bored, you will feel like you are missing opportunities, you will question whether you should be doing more, you will wonder if other traders are getting ahead of you by learning things you do not know. But if you stick with it, if you tolerate the discomfort of limitation and the boredom of repetition, you will reach a level of execution speed and confidence that 95% of traders never experience, because they never stay focused long enough to get there. The choice is not about intelligence, it is not about talent, it is not about market knowledge, it is not about having the right indicator or the right mentor or the right course. It is about whether you can tolerate the discomfort of limitation long enough for depth to develop. Most traders cannot, which is why most traders do not make money. The ones who do make money are not smarter, they are not more talented, they do not have secret knowledge, they just have more reps of one thing than anyone else has of anything. They are specialists in a world of generalists, and that specialization is the entire edge. They execute faster, they execute with more confidence, they manage trades better, they recognize regime shifts earlier, they know when to sit flat, they know when to press size. And all of that knowledge came from doing one thing obsessively while everyone else was dabbling in 10 things casually. The brutal truth is that you already know this. Somewhere inside you, you know that scattering your focus across multiple setups is sabotaging your progress. You know that every time you add a new concept to your trading, you are delaying the moment when you become genuinely competent at any of them. You know that the traders you admire are not traders who know the most setups, they are traders who execute one or two things with absolute precision. You know all of this, but you were doing it anyway because the alternative feels too restrictive. It feels like you were limiting yourself, like you were leaving money on the table, like you were not doing enough. But that feeling is the exact feeling you need to learn to sit with, because on the other side of that feeling is the only version of trading that actually works. Narrow focus, deep repetition, automatic execution, zero hesitation. That is the game. Everything else is noise.